Chinese official factory purchasing managers index fell to an 8-month low, 50.1 in July, with readings around 50 dividing expansion from contraction. The question is, will China stimulate growth? I'm joined down the line today by Ilya Spivak, currency strategist at Forex Capital Markets, to give me his view. Thank you for joining me, Mr. Spivak. First of all, what does this latest data release mean for the sector?
We've seen a slowdown in Chinese manufacturing activity for some time. We saw a post-Great Recession top out in the pace of manufacturing activity around December of 2009, and since the pace has been slowly trending lower, the latest leg lower started about in April of 2012, but the overall trajectory has favored the downside, and this release comes very much within the context of that general tendency.
In 2010, PMI for China was in the 52 to 55 range. The last contraction was in 2011, when it was 49.0. Do you feel we will see a contraction maybe in the next year, as we did in November 2011?
Yes, I think so. I think the outlook for Chinese manufacturing is looking relatively dismal in the near term, primarily because of the sharp, and judging from the recent batch of not only Chinese but Eurozone PMI data, from the sharp slowdown in Europe and the loss of export demand for Chinese firms there.
Okay, and Chinese leaders have tried to reverse the slowdown we have seen for the last 6 quarters, cutting interest rates twice since June and reducing reserve requirement ratios 3 times since November. How would the Chinese government stimulate and stabilise growth?
Well, that assumes that they can. We've obviously had a lot of attempts made at the sort of familiar measures. We've heard recently a lot of talk of fiscal stimulus, which of course is something that China can do. We've had a dose of very aggressive monetary stimulus that China has done before and can certainly put to work again if need be, but whether that is an effective approach this time around remains to be seen. Largely, the worrying sign there is we saw the capital account figures from SAFE released yesterday for the second quarter, and there are some worrying signs there in that there appears to be a capital outflow that has taken place out of China since sometime late last year, and which seems to be continuing and indeed picking up pace. That suggests that the ability of Chinese officials to affect stimulus through basically the loosening of conditions for the banking sector, seeing as how Chinese officials have really sort of formally focused on reserve rate requirement cuts to essentially allow banks to lend more, that kind of policy may start to see diminishing returns and a diminishing ability to be effective if indeed liquidity starts to clamp down because of that capital flight.
Moving on to look at the housing market, is a housing price rebound a possibility, and how will China curb speculative demand in the housing market?
I think a lot of the story in housing has primarily to do with the fact that China really does not have a lot of investment outlets for its increasingly sort of wealthy population, and so once you overlay that with a general sort of mistrust of domestic financial institutions, you do tend to see people invest in more tangible assets, and obviously we've seen a number of asset bubbles in China, and certainly housing has been a major one of those. Obviously, it's been deflating a bit recently, and I would actually expect that to continue. Obviously, markets don't move in straight lines, so you may see, to some extent, a recovery, but Chinese officials have been very clear that any stimulus they do will most likely not touch the housing sector. They've encouraged, in fact, the restrictions on the housing sector that were put in place to kind of deflate that bubble to actually remain in place, even as other parts of the economy sort of being left open for possible stimulus. So I don't think that there's a lot of scope for housing to rebound near term, not only because officials seem sort of determined not to allow too much of an increase, but also because of the investment nature of the housing bubble in general, and of the likelihood that if conditions in China continue to slow, people will likely need to start liquidating some assets and freeing up some cash. And unfortunately, since there is a shortage of viable investment avenues inside of China, housing may be on the receiving end of some of that selling.
Will they resort to stimulus levels after the global financial crisis?
I don't think that, given the current environment, China really has a lot of scope to do as much stimulus necessarily. I mean, they certainly could. They do have the capacity to do a fair bit of stimulus. The larger question is not so much how much stimulus they do, but will the stimulus they do have the kind of potent effect that it had at the height of the global financial crisis. And if, in fact, we do continue to see capital flight out of China and the difficulty that poses for monetary policy transmission as essentially a de facto tightening on the banking sector, I think the potency of that stimulus may prove lacking.
Lastly, do the figures today reflect that the current plan of action is working for China?
I certainly think that it reflects a need to reconsider, because we've seen out of China is a very sort of steady slowdown in manufacturing growth. To some extent, it reflects the success of their prior inflation fighting efforts, but arguably the plan has changed. So if previously Chinese authorities were concerned with fighting prices and were actually looking to slow down the economy, then sort of if that was the plan, then that plan over the recent years has been working, but arguably the plan now is to reinforce growth, and certainly these kind of weaker numbers don't fit well into that picture.
Thank you for joining me today, Mr. Spivak, and sharing your insights. Keep logged on to Dukascopy TV. Coming up, we have a Targets in Focus interview with my colleague Natalie MacDonald. But for now, goodbye.